Welcome to this video, where we provide a guided read of Tesla Inc.'s key fundamentals, sourced directly from SEC EDGAR filings. This is a case study on reading a company's financial fundamentals, similar to how an engineer reads a system diagram. We will explore valuation, profitability, balance sheet structure, and a framework you can apply to any company's numbers. Let's start with why this snapshot matters. At a current price of $374.01, Tesla carries a market capitalization of $1.4 trillion and a trailing price-to-earnings ratio of 346x. This is significantly higher than the auto sector median. We will systematically break down the revenue, margins, and balance sheet to understand this valuation. We use a four-layer model to organize these metrics. Layer 1 is valuation, what the market pays. Layer 2 is profitability, what the business keeps. Layer 3 is the balance sheet, what the business owns and owes. Finally, Layer 4 is per-share economics, what flows to the shareholder. This approach ensures we don't judge a company on one ratio alone. Looking at the margin stack, we see that gross margin is 18.03%. After subtracting operating expenses, the operating margin is 4.59%, and net margin is 4.00%. Each step down the stack shows exactly where revenue is consumed by the company's cost structure, providing insight into the business's operational efficiency. Next, we examine the capital structure. Tesla has total assets of $143.7 billion and a debt-to-equity ratio of 0.09. This indicates a conservative, low-leverage structure, meaning the company relies primarily on equity and internal capital rather than heavy borrowing to fund its large asset base. When comparing strengths and watchouts, we see that conservative leverage and strong cash reserves are key strengths. However, the high valuation, thin net margins, and modest returns on equity relative to that valuation represent significant watchouts that require future growth to justify the current market price. In this case study on leverage, we see that return on equity of 4.51% is achieved by multiplying return on assets of 2.64% by a leverage ratio of 1.71x. Because the debt-to-equity ratio is low, this leverage is largely structural, rather than from borrowed capital, explaining why the ROE is not aggressively amplified. What is the multiple really pricing? A 346x PE ratio implies the market expects earnings to grow substantially faster than they do today. The key levers for this growth are operating leverage, the value of intangible assets like brand and software, and the potential deployment of the company's significant unused borrowing capacity. To summarize, our key takeaways are: never read a multiple alone. Always walk the margin stack from top to bottom. Decompose return on equity to understand the drivers of return. Check debt to equity to assess risk, and compare price to book value to identify intangible asset valuation. For further reading, you can access the primary data using the SEC EDGAR Company Facts and Submissions APIs for CIK 0001318605. The annual Form 10-K provides the full details behind these ratios, and the DuPont analysis framework is a standard tool for decomposing returns on equity. In closing, remember that valuation, profitability, and the balance sheet only make sense when read together as part of a single system. You can apply this four-layer model to any company's filings to develop a consistent and defensible analysis of their fundamentals.